Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Hello and welcome. Now, before I start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This was all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. Now the main pattern here since September 2024, so for over a full year now, had been, though it was once again breached and repaired 2 weeks ago, is the dark blue September to December 2024 bear channel, which is currently 1191 to 1627. That developed into a descending expanding wedge pattern. We are today a little under all the moving averages and a dark blue upper trend line. There are two other patterns that have greatly influenced this market. The first, the origins of which I've spoken about at length, and is the bright green late September 24 to mid-January 25 bearish shift pitchfork. I drew the original bearish Andrews pitchfork for this move some 30 weeks ago, and it seemed back then to be a better contender in showing the bearish angle of attack of the market. But this is no longer true, and I finessed it to the shallower bearish shift pitchfork for the same move. Today we are just beneath the bright green middle time, currently at 1585. Close to the congestion between 1591 to 1659, and that's made up from the February 2020 high at 1591, the June 21 high at 1619, and the May 17 high at 1659. Now the second is another larger bearish pattern I've also previously spoken about, and a good contender even now, showing the bearish angle of attack. It is the longer term bright red November 23 to September 24 shallower bearish shift pitchfork. On this one we are in between the bright red middle time below, currently at 1507, and the bright red upper time above, currently at 1842. Though in truth we're closer to the bright red middle time. Overall, as I said 4 weeks and I quote, I suspect something's going to give and soon, and I am on the watch out for what it will be. And a move higher 2 weeks ago could have been it, but as I said at the time, and I quote, please be aware that this might still be a false break, end of quote. And it was. Ice Europe white sugar in London. After all this time, there still continues to be three features of this market to keep bearing in mind on this daily chart. The first of the three patterns is the obvious and broken, then repaired and then broken again, purple late September 24 to mid-February 25 descending expanding wedge pattern, currently 448.42, way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary, made back in January this year, and had earlier been severely tested on the top side, especially between late February to mid-April, enough that I would not necessarily classify as a descending wedge pattern after February, though I'm still keeping an eye on the extension to the upper trend line and the recent seemingly failed break above it, as well as the changeover gap 5 weeks ago, as I believe it all to be significant. Next, I also asked you 25 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it, end of quote. Well, since then the market started utilizing the bright pink middle time of this bearish shift pitchfork, which is currently at 463.60, as an attractor, riding prices lower in a shallow glide. About 19 weeks ago, the market seemed to become caught in the well-highlighted overhead congestion now between 489 to 490.10 and the bright green extension to the April to June 2021 head and shoulders neckline, which is currently 494.90. We had an attempt over it in early September that was tapped back down by the declining gold long moving average, currently at 494.30, but then held up from below by the seeming support of the February 2020 high zone at 456.70 until 2 weeks ago, when it gave way or pushed below the August 2021 low at 442.5 and down to the lowest lows last week since July 2021. The move down has already reached the primary target for a break below the rectangle of 436.20, but it now leaves just the secondary, and it's a harder to reach target X for the same move of the rectangle down at 418.80. A further feature that has developed over the last few weeks since the beginning of September is also an unhighlighted bear channel. That's currently 419.5 to 451 even. It's early days on this pattern, but it's shown some promise, though I do note how few the touches on the downside, the lower trend line of this bear channel, have been, something that goes against this as a pattern. The final feature is one I'd earlier mentioned. It's a bow tie formation of the moving averages made up from the short moving average, currently at 453.20, the green short medium moving average, currently 469.90, and the mauve medium moving average, currently 472 even. It had a bearish tinge to it, and crossover happened on the 22nd of September. So what did that mean? Well, it begins with a count. So between 20 to 25 trading days after the crossover, we may have one or more of the following: a change in trend, a reinforcement of a trend, volatility. Hence, that was between the 13th and the 20th of October. Look out for one or more of these features. What we saw in that time window was the lowest low since July 2021, thus vindicating the pattern. Sugar white premium spread. I said 5 weeks ago here, and I quote, "Things seem to be trying to resolve themselves into a pattern," end of quote. And over the intervening weeks, they seem to be doing so, just not always the way that I imagined they would. You see, we dispensed with an uptrend, as well as an associated mid-November 24 to early June 2025 bullish shift pitchfork. And I thought we might be moving towards, as I cautioned for a number of weeks, and I quote, "I have a fear, and it is a real fear, that the whole February 2025 today action might be trying to form a possible diamond pattern," end of quote. I continued, and I quote, "This would be a large pattern in time, probably from February to November this year, and in height roughly between just under 100 to up to 150. It's too early to say if this is happening, but I would urge you to keep an eye on such a possibility," end of quote. That possibility looked like being a real possibility until 5 weeks ago, when the market dropped down and below what I thought would be the lowest bullish trend line, which is highlighted in dark blue on my daily chart, currently at 119 even. 5 weeks ago, the market not only dropped below this, let's be honest, it's an unjustified trend line, but went on to drop and close below the gold long moving average, currently at 104 even, and to stabilize further down, dropping and closing below a new support line, the bright red neckline, currently at 97.5, of a new simpler pattern that the market opted to utilize instead of a more complex diamond pattern. And that's a February to early October head and shoulders top. We were, and I suppose might still be, at the early stages of this pattern, but I thought it was appropriate 2 weeks ago to lay out some potentials below for such a pattern, just in case. Thus, the primary target X is in the 70 even zone, the secondary harder to reach target X1 down at 43 3/4. You will easily note that the primary target X is at the lower end of the congestion seen between September 24 to January 25, between approximately 70 to 85 even. Since then, prices may have stabilized, but they have not followed through lower, and indeed we are today above the bright red neckline, if still below the gold long moving average. It was, as I said 2 weeks ago, and I quote, "Only concerted, consistent and long-term moves over the new bright red neckline, and ideally over the slowly rising long moving average, could possibly assuage the bearish potential, at least as far down as the 70 to 85 congestion," end of quote. And this seems to be the case. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.